$450 billion. That's how much wealth vanished from NVIDIA in just 3 trading days last week. And here's the part that should terrify you. The company beat earnings by $3 billion. Revenue, up 62%. Profit margins, spectacular. Guidance, better than expected. And the stock still crashed. 3 days ago, my phone rang at 6. A fellow I've known for 20 years, good man, works in finance, thought he knew what he was doing. His voice was shaking. Warren, he said, I need to know if I should buy more NVIDIA. I'm down $180,000 and everyone's saying this is the dip to buy. I asked him one question. Can you afford to lose another $180,000? Long silence. Then he said, no, that's my daughter's college fund. That's when I knew we'd reached the end. Not the end of NVIDIA as a company. They make excellent products, but the end of NVIDIA is the savior of the stock market. The end of the fantasy that one company, no matter how good, can hold up an entire index trading at 29 times earnings. Today, I'm going to show you exactly why NVIDIA's crash is just beginning, why the AI bubble is bigger and more dangerous than the dot-com crash. And most importantly, I'm going to tell you exactly what I'm buying instead. Because here's what 75 years of investing has taught me. The time to make money isn't when everyone's celebrating. It's when everyone's panicking and nobody knows what to do. Let me start with some arithmetic. And I want you to really pay attention to these numbers because they tell you everything you need to know about what's coming. NVIDIA's market capitalization peaked at $3.6 trillion in October 2024. To put that in perspective, that's larger than the entire GDP of France, larger than the entire German economy. One company making computer chips. Now, they just reported $57 billion in quarterly revenue. That's genuinely impressive. But here's where the math gets uncomfortable. At a $3.6 trillion market cap, NVIDIA was trading at roughly 13 times annual revenue. Let me give you some context. Apple, one of the most profitable companies in human history, with a brand moat wider than the Grand Canyon, trades at about 8 times revenue. Amazon, during its highest growth periods when Jeff Bezos was building the everything store, rarely exceeded 5 times revenue. Even today, after the crash, NVIDIA still carries a market value of about $3 trillion. That requires absolutely perfect execution for years to come. 0 mistakes, 0 competition, 0 slowing demand, 0 surprises. When has that ever happened in business history? It hasn't. Here's another number that should keep you up at night. According to JP Morgan's analysis, AI-related stocks have accounted for 75% of S&P 500 returns since ChatGPT launched in November 2022. Not 30%, not 50%, 75%. That's not a diversified rally. That's not a healthy market. That's concentration risk on steroids. The S&P 500 right now is like a man standing on one leg. He might look stable from a distance, but the moment that leg buckles, he's going down hard. And that leg, NVIDIA, just buckled. Now, let me walk you through why NVIDIA literally cannot continue carrying this market. And I'm going to use math that a 6th grader could follow. NVIDIA grew revenue 62% year over year in its most recent quarter. For a company that size, that's extraordinary. I mean that sincerely. Jensen Huang has built something remarkable. But here's the problem with exponential growth expectations on massive bases. The math stops working. For NVIDIA to continue growing at 60% on a $3 trillion market cap, they would need to add roughly $1.8 trillion in value every single year. That's the entire economy of Canada, every year, forever. Or look at it another way. To justify today's valuation, NVIDIA needs to become more profitable than Apple, Microsoft, and Google combined, and stay there for decades. Does that sound rational to you? I've been studying businesses for over 70 years, and I can tell you with certainty, no company in history has defied this kind of mathematics. not IBM in the 60s, not Microsoft in the 90s, not Apple in the 2010s. The bigger you get, the harder growth becomes. That's not a criticism of management. That's just arithmetic. And the market is finally figuring this out. Last week, NVIDIA reported earnings that beat analysts' expectations across every single metric. Data center revenue, up 66%. Guidance for next quarter, well above Wall Street estimates. In a rational market, that should have sent the stock soaring. Instead, it fell 5.5% that day. The NASDAQ dropped 3%. The S&P 500 lost 1.5%. You know what that tells me? The market has started asking the right question. It's not how good is NVIDIA's business anymore. It's how much future growth is already baked into this price. And the answer is too much. We're witnessing peak valuations colliding with peak expectations. And when those two forces meet, the result is never pretty. Now, before I tell you what I'm doing with my money, I need to explain something that most investors have completely missed. Something that, when you understand it, will change how you see this entire AI boom. Michael Burry, you might remember him from betting against the housing market in 2008, recently wrote something on X that caught my attention. He said, and I quote, "True end demand is ridiculously small. Almost all customers are funded by their dealers." Let me translate what he's saying, because this is important. NVIDIA invests money in OpenAI. Then OpenAI commits to buying hundreds of billions in NVIDIA chips over the next few years. Microsoft invests in OpenAI. And Microsoft also invests in CoreWeave, an AI infrastructure company. CoreWeave then rents computing power back to OpenAI using NVIDIA chips. And NVIDIA, they have an equity stake in CoreWeave too. You see the circle? Money flows from NVIDIA to OpenAI, which flows back to NVIDIA through chip purchases, while Microsoft funds multiple players who all buy from NVIDIA. And NVIDIA owns pieces of the companies buying its products. When I started in this business 70 years ago, we had a name for this kind of arrangement, vendor financing. And it was always a red flag. The last time I saw vendor financing practiced at this scale was during the dot-com bubble, when companies would loan money to customers to buy their own products, then book those purchases as revenue. It created an illusion of demand that evaporated the moment the financing stopped. Now, I'm not suggesting anyone's doing anything illegal. Vendor financing happens in various industries, especially during infrastructure build-outs. But the scale we're seeing now is unprecedented. We're talking about tens and hundreds of billions of dollars circulating within a closed ecosystem of about a dozen major players. And here's what happens when this circle breaks. And trust me, it always breaks eventually. One company in the chain starts questioning the return on their AI investment. Maybe they realize their massive spending on data centers isn't generating the revenue growth they promised shareholders. So they scale back their next capital expenditure budget. That impacts NVIDIA's next quarter. NVIDIA's stock drops. The companies holding NVIDIA stock as part of their AI investments see their balance sheets deteriorate. They cut spending further. The circle becomes a spiral, but now it's spiraling downward instead of up. We're already seeing the first cracks. OpenAI, despite its $500 billion valuation and all the hype around ChatGPT, is losing billions of dollars annually. Its projected revenues for 2025 are around $13 billion, but it's committed to spending $60 billion per year on computing power with Oracle alone over the next 5 years. That's not a sustainable business model. That's a company burning through cash while hoping that someday, somehow, the economics will work out. Oracle's story is even more telling. The company announced a massive deal with OpenAI earlier this year. Its stock soared 40% in a single day, adding nearly $1/3 trillion to its market value. But you know what? According to a CNBC report, Oracle is losing money on the deal. They expect to lose considerable sums renting data centers primarily to OpenAI, having already incurred a $100 million loss in their most recent quarter. Think about that for a moment. Oracle announced a huge AI partnership. Wall Street celebrated. The stock went through the roof. But the actual economics of the deal are unprofitable. That's not investing, folks. That's speculation masquerading as business strategy. I've lived through enough market cycles to recognize the patterns. And right now I'm watching a remake of a movie I've seen before. The details are different, but the plot is exactly the same. Let me take you back to March 2000. The NASDAQ peaked at 5,048. Companies with no profits were trading at valuations that made no sense. But everyone had a justification. The internet changes everything. Traditional valuation metrics don't apply. You old guys just don't get it. I heard all of it, and I didn't buy a single .com stock. You know what happened next? By October 2002, the NASDAQ had fallen to 1,114. That's a 78% decline. Companies that had been worth billions became worthless overnight. Pets.com spent $300 million on marketing and went bankrupt 9 months later. Webvan raised $375 million in its IPO and was liquidated within 2 years. And here's the part that people forget. Even if you had perfect foresight and knew which companies would survive, you still could have lost money by paying too much. Cisco was a great company, one of the survivors. But if you bought Cisco stock at the peak in 2000, it took you 17 years just to break even. Amazon eventually became one of the most valuable companies on earth. But first, it dropped 95% from its peak. Only investors with iron stomachs and decades of patience made money. Now, I know what some of you are thinking. Warren, AI is different. These companies have real earnings, real products, real business models. And you're right. Today's tech giants are more profitable than the .com companies I avoided in 1999. But profitability doesn't insulate you from paying too much. As I've said many times, price is what you pay, value is what you get. And right now, the market is paying record prices for value that becomes increasingly questionable with each passing quarter. The S&P 500 Shiller PE ratio, which smooths earnings over 10 years to avoid temporary distortions, stands at 39.2. The only other time it was this high, October 2000, right before the NASDAQ crashed, 78%. A Bank of America survey just revealed that 45% of fund managers now identify an AI bubble as the single biggest threat to markets. That number was 33% just 1 month ago. When half of professional money managers are publicly saying they see a bubble, you can be certain the private concerns are even more dire. The VIX Volatility Index jumped 14% last week. Declining stocks outpaced advancing ones by more than 3-to-1 on the New York Stock Exchange. These aren't the signs of a healthy market. These are the signs of a market that knows it's overextended but hasn't figured out how to walk back from the edge. So here's what I'm doing, what Berkshire is positioned for. First, I'm reducing exposure to anything trading at extreme valuations with no margin of safety. My teacher, Benjamin Graham, taught me the 3 most important words in investing. Margin of safety. You want to buy things for less than they're worth. So even if you're wrong about your analysis, you still have a cushion. What's the margin of safety in NVIDIA at $178 per share after beating earnings and still falling? There isn't one. You're paying full speculation price and hoping someone will pay you even more tomorrow. That's not how I invest. That's not how anyone should invest if they want to sleep at night. Second, I'm watching portfolio concentration carefully. At Berkshire, we've always believed in concentration when we find great businesses at good prices. But there's a difference between concentrated conviction and concentrated speculation. For the past 2 years, the market's winning strategy was simple. Own the Magnificent Seven, especially NVIDIA, and you'd outperform. But that strategy only works as long as these stocks keep rising. When your hero stumbles, concentrated portfolios become extremely vulnerable. Third, I'm looking for what I've always looked for. Businesses I can understand, run by people I trust, available at prices that make sense. While everyone's chasing AI, I'm buying companies like the ones we've always favored at Berkshire. Companies with simple business models, products people need in good times and bad, strong balance sheets, consistent earnings power, reasonable valuations. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, which we've owned since 1988 and will probably own for another 88 years. These companies won't double in 6 months. They won't make headlines, but they'll keep generating cash, paying dividends, and compounding value year after year. I'm also looking at the companies that power AI without carrying AI valuations. You know what all these AI data centers need? Electricity. Massive amounts of it. So I'm interested in utility companies that supply power to data centers. Companies with regulated monopolies, predictable cash flows, reasonable valuations, and dividends. They won't give you the excitement of a tech stock, but they'll give you something more valuable. The ability to sleep at night. I'm looking internationally too. The U.S. market is expensive, but value exists in other parts of the world if you're patient and disciplined about looking for it. And I'm holding cash. Berkshire is sitting on over $300 billion in cash and treasury bills right now. Some people criticize us for that. They say we're missing out on gains. But cash is not trash when it's earning 4.5% risk-free. And more importantly, cash is optionality. When prices get more reasonable, we'll have the firepower to act. As I wrote in my 2016 shareholder letter, the unconventional but inescapable conclusion to be drawn from the past 50 years is that it has been far safer to invest in a diversified collection of American businesses than to invest in securities, bonds, backed by the full faith and credit of the U.S. government, but only at the right prices. Let me tell you something I've learned over 75 years, something more important than any individual stock pick. The goal of investing is not to maximize returns at any cost. It's to compound wealth steadily over time without taking risks that could wipe you out. Rule number 1, never lose money. Rule number 2, never forget rule number 1. That's not just a catchy saying. It's the foundation of everything I do. I've been asked thousands of times, Warren, how did you become so wealthy? And the answer is simpler than people want to believe. I avoided disasters. I didn't buy dot-com stocks in 1999. I didn't buy gold in 1980 when it hit $850 an ounce. I didn't buy real estate in 2006. I missed out on some gains, but I also avoided catastrophic losses. And in the long run, avoiding catastrophic losses is far more important than catching every gain. Let me give you a test. I call it the sleep test. If NVIDIA dropped another 50% from here, could you hold your positions and sleep well at night? Could you continue with your life without obsessively checking your portfolio? Could you avoid panic selling at the bottom? If the answer is no, if you'd be up at 3 a.m. in a cold sweat, then you're taking too much risk right now. Charlie Munger used to say, it's waiting that helps you as an investor, and a lot of people just can't stand to wait. I can wait. I've been waiting since 1942 when I bought my first stock, and I'll keep waiting for the right opportunities at the right prices. That fellow who called me at 6 with his daughter's college fund in NVIDIA, I told him to sell half immediately. Take the loss. Accept reality. Put the money somewhere safe while he figures out what to do next. But Warren, he said, what if NVIDIA bounces back and I miss out? And I told him what I'm telling you now. You never go broke taking a profit, and you never go broke avoiding something that makes you lose sleep. He sold 2 days later at $175 per share. This morning, NVIDIA is trading at $168. He called to thank me, said he's sleeping better now. That's the goal. Not to beat the market, not to have bragging rights at cocktail parties, but to build wealth while sleeping well at night. Let me leave you with this. In 2008, when financial markets were collapsing and everyone was terrified, I wrote an op-ed for the New York Times. The title was, "Buy American, I Am." That wasn't heroism. That was simple recognition that prices had fallen to levels where value exceeded price, where the future productivity of American business was being offered at sale prices. Today, we face the opposite situation. Prices have risen to levels where they significantly exceed any reasonable estimation of value. I've said before, be fearful when others are greedy, and greedy when others are fearful. Right now, there's a lot of greed in the AI sector, a lot of euphoria, a lot of people convinced that this time is different. But it's never different. The details change. The technologies evolve. The names are new. But human nature remains constant, and mathematical reality remains constant. NVIDIA is a phenomenal company. Jensen Huang has built something truly remarkable. I have enormous respect for what he's accomplished. But being a great company doesn't make you immune to the laws of valuation. At current prices, even continued excellence may not be enough to justify the expectations embedded in the stock. As my partner Charlie used to say, there are worse situations than drowning in cash and sitting. I remember when I wasn't awash in cash, and I don't want to go back. I'm sitting, waiting, watching, looking for opportunities where price and value align. When I find them, I'll act decisively. Until then, I'll hold cash, collect my 4.5%, and sleep well knowing I'm not taking risks I can't afford. As I wrote in my 1987 shareholder letter, after the market crash that year, we've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children. I won't predict when this correction becomes a crash. I won't tell you exactly when to sell or exactly what bottom looks like. What I will tell you is what I've always believed. Focus on businesses you understand. Pay attention to price. Maintain a margin of safety. And remember that your goal is to compound wealth over decades, not chase momentum over quarters. The market can remain irrational longer than you can remain solvent. But eventually, gravity reasserts itself. Eventually, price and value converge. That fellow with his daughter's college fund is sleeping better now. His wealth is secure. His family's future is protected. Stay rational, disciplined, and patient. Make choices you can live with, no matter what the market does.